currency management. This is the only chapter on currency for level 3, right? Initial part is a bit of introduction. Base currency is the denominator of the exchange rate, and it is priced in terms of numerator. This is not very relevant, but suppose this quote is given, then this would mean 0.98 CAD per USD, right? And usually in currency, spot transaction means delivery in 2 days. USD/CHF means rate of 1.07. So 1.07 USD per CHF, and you are buying 500,000 CHF. Then obviously currency will have bid offer or bid ask quotes. For example, this. So if you want to buy US dollar, you can do at 0.981 CAD. If you want to sell US dollar, you can sell at 0.9790 CAD. Spot versus forward. Acha, now this is something new. See, so far I think in L1 and L2 we were given to understand that point means basically 0.01% means 1 divided by 10,000. There is a change as far as level 3 curriculum is concerned. We are saying that you have to look at the decimal places given in the spot quote. So suppose here 1.33, 2 decimals appear there. So when they say forward points 1.1, you have to divide that 1.1 by 100, because spot point will be divided by, and here 10,000. અને જે અત્યાર સુધી હતું હવે એને myth કહે છે કે always divide by 10,000, that's a myth. Is this clear? Okay, try this example. What is the 30-day forward? So 1.2571 minus 1 by 10,000, 1.2574 minus 0.9 by 10,000. Acha, this is interesting. See, the quote is for euro. Now they are saying manager sells 1 million. When will the exchange take place? Euro. Acha, if you are buying euro, तो rate कयो लागसे? 1.2574 will apply. This one, right? And you are going to buy euro with 1 million AUD. So you receive 1 million divided by 1. બરાબર છે? both of you? Okay, I think this is a mark to market. You have to find out the value of the position. Try करो. Based on initial quotes given in the previous example, different manager entered into a trade sell euro 10 million 90 days forward at this rate. 1 euro is equal to 1.25827 AUD. Now 30 days have passed and exchange rates are following. So we have to take into consideration 60-day rates. Right? So they are asking identify the offsetting position the manager would take to close the initial transaction. So you wanted to sell euro, now you will have to buy euro for 60 days maturity. And buy means 1.3191 plus 10.5 by 10,000. So this is the rate. Acha. Now you had sold at 1.25827 and price has increased. So you are going to incur a loss. Right? You are going to incur a loss. JB difference have multiply by 10 million. So this is the loss 618800 AUD. Make sure you are getting this number. I think this is the better method. એ લોકો જે કરી છે ને. Just take the difference of two quotes, multiply by 10 million euro. So 6,18,800 AUD is the loss which will be realized after 60 days. Value, then take the present value. અહીંયા તો USD ના જ rates આપ્યા છે, sorry AUD ના જ rates આપ્યા છે. But to confuse you, they might also give rates for euro, interest rate for euro. Okay. So be careful. We are going to have a loss of around 6 lakhs AUD. So interest rate also should be for AUD. And applicable rate for 60 days AUD is 1.2%. એમાં simple interest પ્રમાણે પછી present value find answer mark to market loss. Okay. Then FX swap is a misnomer. Actually બહુ કઈ swap જેવું છે નહીં. It simply rolls over a maturing forward contract using a spot transaction into a new forward contract. So suppose you have taken a position 1 month forward. Now that 1 month is about to end. So you will settle that by taking a opposite position in spot market because expiry, and then further take one more forward position, say which matures after 1 month. એટલે જે આપણે નોર્મલી રોલ ઓવર કહીએ ડેરિવેટિવ્સમાં એક કરન્સીમાં FX swap કહેવાય છે. So look at this example. manager purchased 10 million South African rand 3 months forward at this rate. But rate પાછો USD નો આપ્યો છે. Whatever. 2 days before contract expiry, manager decides to extend the transaction for another 30 days. તો આને તમારે સેટલ કરવું પડશે. Sell ZAR in the spot market at whatever is the prevalent rate, and you will again book a forward contract to buy ZAR, which is 30 days. બરાબર? Okay. Then currency માં options ઘણા વપરાય. તેનું basics આપ્યું છે. Just go through once, and we know that if it is very much in the money, then delta is 1, out of money delta is 0, at the money is 0.5. Another thing worth noting is, suppose there is a call option on USD versus INR, American dollars, but that also means you have the right to sell Indian rupee. તો એ ખાલી થોડું નવું હોય. Otherwise rest of the things are quite basic. So just go through. Let me know if you don't understand anything. कोई भी terminology ना खबर पड़े तो को. I think they have made it needlessly complex. આટલું બધું કંઈ યાદ રાખવા જેવું છે નહીં. બોલો ડન. Okay. અચ્છા. Now this next section, it is mainly important for the terminology. So domestic currency or home currency is the currency of the investor. So let us who wants to invest in India. So for him or her, domestic dollar. Domestic asset is any asset denominated in dollars. Foreign currency is Indian rupee. And foreign asset is maybe Indian stocks or Indian bonds. Acha. Or local currency or local market. I find this a bit confusing. I had to put some effort to memorize. Okay, what is local and what is domestic? So domestic is investors' home country. Local is the investment destination. Is the return of for a foreign asset measured in its local currency? Means Nifty returns in terms of rupees, also called local market return. Percentage change in the value of foreign currency. So that is rupee versus dollar. And then domestic currency return. So suppose US investor has invested in his or her return in terms of US dollars. And this is fairly simple. Suppose Nifty goes up by 10%, but Indian rupee goes down by say 3%, then approximately the return would be 7%. But exactly if you want to calculate, then you can always do 1.10 into 0.97. So try this example. So euro goes from 1.3 to 1.339. So euro is also appreciated. So then you compound 5% and 3%, 8.15, and then just 8%. Then this is not required. Then obviously investors will have returns from various currencies and various assets. So try this one. This is a good example. $75 assets. This is 75%. Dollar is 25% of the portfolio. Dollar denominated assets. Then this GBP in terms of GBP 12%. You calculate this percentage. In pound versus euro. Let me also calculate. So I'm getting minus 1.96%. USD is concerned, but they in a reverse way. એટલે તમારે આને ઊંધા કરવા પડશે. This is 0.7. 0.75. 53. Okay. 0.73. So then calculate the change, percentage change in these values. Be 0.6%, right? Now you compound this two, this as well as this. So this is 9.80%. Then 5.63%. Kayu, which one? This around 0.98. Minus 1.96% છે ને એટલે 1 minus 1.96 by 100. હા. And then you combine these two returns in 75-25%. I'm getting 8.76. Right? પલક બરાબર છે ને? Okay, so this was about return. Now risk also will compound, but as in the formula for portfolio risk, one of the major, the correlation between currency return and your local asset return, right? So that interaction will be very important. They have given various versions of the formula which is not really required, right? See, you can just go through this. Basically, if correlation is less than 1, then there means if I say that Nifty India, Nifty risk is 10% and rupee versus dollar risk is 5%, then overall I am not going to face fully 15% risk. I am going to face less than 15% because correlation between these two things will be less than 1. That is what they are trying to say. And lesser the correlation, more will be the risk reduction. So just go through this. Done? And this is a special case. If you are investing in a foreign currency denominated risk-free asset, then all that matters is the currency risk. Okay, now strategic choices. So it's a very open question whether to hedge or not and whether to fully hedge or not, right? So these are arguments made for not hedging. Best to avoid the time and cost of hedging or trading currencies. In the long run, unhedged currency effects are a zero-sum gain. If one currency and in the long run, currencies revert to a. So these are arguments in favor of doing nothing. Then there are arguments in favor of doing something, right? So in the short run, it can be extreme, the currency movement. And markets are not always efficient, so there might be avenues to add some value, add to portfolio return. Many forex trades are dictated by international trade transactions or central bank policies. So these are reasons why efficiency. Currency management strategies. They range from a passive approach of matching benchmark currency exposures to an active strategy that treats currency exposure independently of the benchmark exposures and seeks to profit from it rather than hedge. So safest is passive hedging. It is rule based and typically matches port. So if your benchmark is fully hedged, you also hedge. If your benchmark is not hedged, you don't hedge, but still it will be called passive hedging. Goal is to eliminate currency risk, not absolutely, but relative to the benchmark. Then discretionary hedging. So you are hedging, but from passive hedging by a specified percentage. Say 5% deviations are allowed. While allowing the manager to purchase. Then active currency management. So manager can have greater deviations from benchmark currency exposures. So amount of discretion permitted is more, and the manager is expected to generate positive incremental returns from managing currency exposure. So now you are looking at currency as a source of return. Goal is to create incremental alpha, not reduce risk. And then currency overlay. So now you are simply treating currency as a different asset class, and you might even hire different managers to create more value through currency. So just go through this. You should have a good understanding of what we mean by currency overlay. So basically, there is outsourcing of currency management. That even if there is no portfolio exposure to Swedish krona, still that currency manager might take some position just to make a profit from that currency position, purely seeking currency alpha. And sometimes overlay managers can be given a mandate to reduce risk. Then what is to be done about currency? Hedging karwanu, nahi karwanu, deviation allowed, not allowed. Everything has to be as per the IPS. Relevant sections are objectives, time horizon, liquidity needs, and benchmark to be used. And IPS should also specify all these aspects. I think you should remember this. Sir Lakwama. Okay, go through this example. USD based portfolio has little need for liquidity and is focused on short term performance results. Client evaluates performance relative to a global equity index which fully hedges currency and rebalances monthly. Discuss how managers views on hedging currency exposure in the portfolio. So we are evaluated with respect to an index which is completely hedged, and the client is focused on short term results, so maybe hedging preferred, right? But on the other hand, he does not have liquidity need for liquidity. That would mean maybe full hedging is not required. So you should be able to give both sides of the view. Why rebalancing could be needed even if no changes are made to asset holdings? So that will be needed because values will change. Just go through the answers. So I think this is the key because focus is on short-term results. You cannot have the assumption that currency does not matter. It will matter. And as I said, lack of liquidity requirement would generally mean that there is not much need for currency hedging. When they have given this a very long explanation, basically asset values will keep on changing. So you would need to rebalance. Is this fine? Okay. Then strategic diversification issues. In the long run, currency volatility has been lower than in the shorter run, obviously. So if your portfolio has a long-term perspective, it reduces the need to hedge. Then this we know positive correlation would increase volatility, negative correlation would decrease the volatility and the need to hedge vary from time to time. Usually there is a higher positive correlation between asset and currency returns in bond portfolios than in equity portfolios. If that is true, then if you are holding international bond portfolios, then there will be more reason to hedge rather than equity portfolios, right? Because here riskiness of asset and currency are more likely to reinforce each other. US investor who has invested in India, if there is capital outflow for whatever reason, then in India yields will go up. India bonds will fall in price. Indian currency will also depreciate. So there is more is required, which may not be the case for equity portfolios. Then these are the cost issues. Just go through bid ask transactions. These are all transaction costs. Full hedging will be costly. If you want to keep the upside, you can purchase options, but then you will have to pay for premium. Forward contracts will not be always be available for longer term, so you will have to roll over. Rollover can create cash flow volatility with realized gains and losses. Just go through. In some of the answers, you might need to reproduce. બધું યાદ રાખવાની જરૂર નથી, but just some of the basic things. બોલો done. And this is a good summary. Factors that shift strategic decision toward fully hedge or benchmark neutral strategy are shorter time horizon, higher risk aversion, client who is unconcerned about opportunity cost of hedging, high liquid, significant foreign currency bond exposure, hedging cost if, and clients who are not convinced about benefits of discretionary management. ફર્સ્ટ ક્વિઝમાં ખાસું આપ્યું છે, જોઈ લેજો. બૈસાખી સોલ્વ કરવું પડશે તારે, right? Let us complete a bit more of this chapter. So after the quiz, what they are saying, so this is fairly easy. If you want to do active management and trading, then you can do forecasting based on economic fundamentals or technical analysis, right? Very nice statement. None of the approaches work consistently. Increase in value of currency usually happens when there is more undervaluation. They have the greatest rate of increase in their fundamental value. This is inflation is lower with respect to other countries, and where risk premiums are decreasing. Generally, when risk premiums are decreasing, that currency is attracting inflows, and so it tends to appreciate. Then technical, just go through. Support, resistance, overbought, oversold. Basic assumptions of technical analysis, just go through. And you know, right, support or resistance prices tend to be sticky. But once a support or resistance is broken, then it also means significant further up move or down move. A shorter term moving average rising above higher term moving average is generally a buy signal. Okay, carry trade. So borrow in a currency which has got very low interest rates, that is called the funding currency, usually Japanese yen. And off late, not after 2020, but before that, US dollar interest rates were very low. So investors were borrowing in Japanese yen or US dollar and investing in assets of currencies which have high yield, mostly emerging market currencies, right? Then as per interest rate parity, see currency which has got higher rate, that currency should depreciate by, but practically that does not happen. If that were to happen, carry trade return would be zero. But for a variety of reasons, that does not happen. Okay. What has been observed is that higher interest rate currency has depreciated, but not by that much, right? Sometimes carry trade gets into trouble and it can generate large losses. Usually, when there is some kind of a crisis or some big event which is stressful, all the emerging market currencies fall by a lot and fall along with each other. So, this kind of carry trade, they have to keep some kind of a stop loss. Otherwise, there can be significant losses. Just go through this much, then we will have a look at the example. Okay, example માં શું કીધું છે? 1 USD is 2.41 BRL. Interest rate in two countries is 1%, 6%, right? So, what is the theoretical exchange rate? Forward exchange rate for Brazilian real. 1 USD is 2.41 real per interest rate, so it should appreciate. So 2.41 into 1.06 by 1.01. Roughly it should appreciate by 5%. So it is coming out to be 2.529. Steps to initiate the carry trade. So you would borrow in Brazilian real at 1%, right? Convert it to dollars. Sorry, you will borrow in US dollars at 1%, convert it into invest at 6%, then get the proceeds real and reconvert to dollar. Obviously, if the exchange rate becomes 2.529, there is no profit. In third, exchange rate is unchanged. So if exchange rate is unchanged, clearly you can make. Primary risk is that Brazilian real can depreciate by more than 5%, then your profit will be wiped off. Is this fine? ठीक है ना? This is just the summary, and it is generally profitable under normal market conditions. If there is a period of financial distress, it can generate large losses. And the fourth strategy is volatility trading, right? For options, Vega is the sensitivity measure which gives you idea of how volatility will impact the premium of the options. Obviously, Vega is positive for puts and calls. And if you want to take a call on volatility, you can do some strategies that we will learn in option chapter. Mostly you can do straddle. Straddle means you are buying a call, buying a put. So if you think volatility is going to increase, you can do a long straddle. If you think volatility is going to decrease, you can do a short straddle. When you So you can do a strangle. Benefit of strangle is that initial investment will be lesser. Stop here. Next time we will start from 18.4. Okay.